Okay, so we are about to start our first panel discussion. This morning, the topic is Global Economic Outlook. So we are very happy to invite distinguished speakers here. So give a very short introduction. Their bios are available on the brochure. So sitting to my left is Michael Gapen. Michael is the Managing Director of U.S. Economist at Barclay. So Michael is responsible for the firm's outlook for U.S. economy, and in particular U.S. monetary policy and the impact of the financial markets on the economy. So prior to joining Barclays, Michael worked at the Board of Governors of the Federal Reserve and the International Monetary Funds, respectively. So the second to my left is Constance Hunter. So Constance is the chief economist at KPMG. She's known for identifying economic inflection points and providing actionable economic insights to C-suite clients and KPMG leaderships. And besides his role at KPMG, Constance was also recently named Vice President of the National Association for Business Economists. So last but not least, we have Ebrahim from Citi. Ebrahim was recently named as the G10 Currency Strategist and Global Head of FX Analysis and Content. And before he assumed this role, I think Ebrahim is the head of Global Economic Research at Citigroup. So with that, we're going to start our panel discussion. So the format of the panel discussion, each of our speakers will provide some introductory remarks. Each one have about 5 minutes, and then I will proceed with some questions. And then with that, maybe we can start with Michael.
Okay, thank you for that, and good morning. In terms of what I'll open with, I'll just give a few thoughts on what I think the outcome of the U.S. election means for the view on the U.S. economy going forward. So prior to the election, I'd say the average economist who sits in my position, who looks at the U.S., we were thinking fiscal stimulus at this point of the business cycle is more like a sugar high than a transformational event, that growth would remain above trend for a while, it would continue to push the unemployment rate lower, it would lead the Fed to be able to tighten policy more regularly. But it's a situation where growth should be strong now, but gradually decelerating over time. I think the election outcome reinforces that view. So you're likely to hear people like myself and many in the markets continue to think that there are increasing recession risks in the U.S. economy over time. I say this mainly because the most likely outcome in the election is what happened. The polling was right this time around. There was likely to be a switch in party control of Congress, with the Democrats taking control of the House, but Republicans retaining control of the Senate. The second most likely scenario in most investors' eyes was a Republican sweep or a Republican hold of power. And in that world, many expected further fiscal stimulus to keep the economy growing through the 2020 presidential election. So we got an outcome of divided government, which is likely to lead to a stalemate in terms of additional spending. We don't think an infrastructure bill is likely. So I think you'll find that this reinforces most people's view that their baseline outlook is correct, that the U.S. economy will gradually slow and decelerate over time, monetary policy is likely to get tight, and the U.S. economy will be viewing recession risks in a few years' time. So I think the main outcome of the election in terms of what it means for the economy is just increased conviction around this view.
Okay. Yep, Constance.
So, hi, thank you very much for having me here, Henry. It's a pleasure to speak to you all this morning. So I would agree broadly with Michael's views. I'm going to delve a little bit into some things that might cause a recession or a slowdown in U.S. GDP and some risks that are happening globally. So just within the U.S., there are pockets of labor shortage that are really growing. So one of the things that we do on my team is we do a word count analysis of the Beige Book, which is a survey that the Fed conducts throughout the entire country of business leaders. And when we match the word count for words indicating labor shortness, we're definitely at a peak we haven't seen over the last 2 decades, and it will indicate higher wages, which will, in the short term, cause more consumption in the economy to grow, but unless those wages are coupled with productivity growth, we're not going to really see sustained real growth in wages. So that labor shortage and those increasing costs of labor is something that really has the potential to slow GDP and in some cases push us into recession. Of course, there's always the possibility that the Fed over-tightens. So if we look historically, whenever the unemployment rate has been below the natural rate, the Fed has not been able to engineer a soft landing. Now, the Fed is always learning, it's always improving, it's always studying the past and trying to make better decisions going forward. So it's possible this is the first time the Fed is able to do that, but it is not probably likely. Then if we turn our attention globally, there are 2 main things, both stemming from the fact that interest rates are going up, not just in the US, but if you look at the long end of the curve, certainly in countries across Europe. We now have the Bank of Japan saying, look, we know growth is slow, but we also recognize that there are limits to monetary policy. So there's definitely a feeling that not just U.S. rates are going up, but that rates around the world are going to be drifting higher. And that would not necessarily be problematic, except that there has been a great amount of debt amassed globally since the financial crisis. I would point first to Italy, where the Italian government is really taking a stand against the core of Europe, and it remains to be seen what will happen. There's sort of a series of showdowns that are likely to occur from now until the end of the year. So there's a question about whether or not Italy will be sanctioned for this budget. If they are, then they will theoretically have to pay fines. One of the things that the Italian government has done is actually talk to China about providing some financing for them. And there are good reasons why the ECB would back down, or the European Commission would back down. There are good reasons why they would carry on. Then the second thing is the LTRO loan program. Basically, if that is not renewed in December, Italian banks are going to have to finance themselves on the open market. That, again, is something that could cause friction, so I would pay close attention to Italy. Then the second thing I want to highlight is actually about Chinese debt and the amount of non-financial corporate debt, the pace of growth. So it's grown about 223% since 2009. And this corresponds with a GDP growth rate that's almost 100% since the financial crisis. And if you took away that debt, you'd have to ask what would the growth rate be. If anybody has read Ray Dalio's latest book, he talks a lot about bubbles and the growth of debt. And one of the things that he mentions in the book is that it is always accompanied with a growth of shadow banking, so that is certainly something that has occurred in China. So I would just put out a note of caution about the pace of the accumulation of debt and the way that has been accumulated within the Chinese economy that may pose challenges going forward.
Okay, yeah, Ebrahim.
Well, good morning also from me. It's a pleasure to be with you this morning. As Henry mentioned, I have recently changed roles and I have taken over our FX analysis at Citi for the whole of the last 2 weeks. So what I'm going to do is try and pivot slightly. Maybe I agree with much of the comments we heard before, but pivot slightly to financial markets and really try and make 3 points quickly. One is we are beginning to see increasing signs, I think, of, if you like, late cycle environment in financial markets. The second is that I think overall for the near term that still means the dollar has some tailwinds. And the third is that in the end I think the direction in which we will go will probably be decided by China. So China is really key. So starting with the first, and actually it touches on some of the points that Constance just made. I think when we look at financial markets today over the last couple of weeks, I think there's some really interesting things going on. They're not definitive, but certainly seem to suggest that some patterns are changing, and many of them are linked to the fact that interest rates are now rising, that when interest rates rise, that tends to be associated now with some combination of declining equity prices, or at least some volatility in financial markets more broadly, and that these are at least, they can at least be interpreted as a sign that financial and monetary conditions globally are becoming tighter, and these could well mean that since they were a big support for financial markets over the last few years, that financial markets will face major challenges. And with financial markets being challenged, I think the chances of seeing a turn in the cycle will go up quite markedly. Now, very often we're asked, where do we think we are in the cycle? Are we late? Are we early? I think really the question should be, what level of resilience do we have to shocks? And I think what some of these patterns suggest is that I think resilience is coming down. That doesn't mean we're facing recession sometime soon. It just means that whenever we're confronted with bad things, I think we'll be less able to cope with them easily. And just to remind you, I was looking at some of the studies from the IMF and others recently. I think the average pattern is the year before a recession across advanced economies, the average GDP growth forecast is 2.8 or 2.9, and the average unconditional forecast is 3%. And this is just ahead of the beginning of that year. So it just tells us that very often these events can unfold quite quickly. Now, second, about the dollar specifically, I think when we look at the dollar, we should always remember that the value of the dollar is more often driven by what's going on in the rest of the world than what goes on in the US. I think that's particularly true right now for two reasons. One is because the dollar is pretty highly valued and has been for some time, and that means quite a lot of US outperformance is already reflected in market prices. And the other is that there are a lot of things going on elsewhere that I think are ultimately more relevant than the near-term outlook in the US, which of course still remains very important. Constance mentioned Europe. Despite my funny name, I'm actually German. So I watch that region still quite closely as well, and I totally agree with her that particularly developments in Italy are a negative for financial markets there, for the euro relative to the dollar. But it's not only that. I think Europe is facing now a number of challenges, including from the slowdown in the global industrial cycle, which probably is more linked to China than anything else. And then, of course, we are still facing, despite some more mixed messaging, a much more dovish central bank there than in many other places. And then, of course, there is China, which brings me to point number 3. I think right now China is really critical for the global outlook, for the global growth outlook, but for financial markets more broadly. And it's really because it's at the center of three trends. One is that the Chinese economy has clearly been slowing, continues to slow, and that slowdown had been quite broad, not just in investment and in industrial trends, but also from the consumer side. The second is that China is, of course, at the heart of the global trade tensions. So when we talk about U.S. trade policies, the ones we care about most are clearly the interactions with China. But then on the other hand, 3, we are now in a phase where Chinese policy is clearly easing, and I think the degree to which that will be effective will, I think, determine the trajectory for Chinese growth, global growth, but then coming back to exchange rate, probably also a range of exchange rates, including in developed markets. If China manages, as I expect, at some point to stabilize growth over the next year or so, then I think that will probably be the time when the dollar will have reached its peak. And let me end with a quick final comment on the Chinese exchange rate, which also garners a lot of attention, even if you only look at developed market exchange rates, and that's because very often it is seen both as a direct influence into many other parts of the world, but also as a sign that we should become more concerned about the global outlook. And I was in Asia for a couple of weeks over the last month, and it was striking how bearish sentiment, and particularly private sector sentiment, was in China, and I think that in the end constrains. On the one hand, I think it tells you why maybe the Chinese exchange rate should be a lot weaker than it is today, but it also tells you that it might not be that easy to make the exchange rate be that shock absorber. So I think we will see the Chinese exchange rate continue to be a very tricky policy lever to be used by Chinese authorities, and therefore that I see it as a residual rather than the protagonist in the policy response.
All right, thanks. So it seems that, most of our speakers agree that the U.S. economy is in the rate cycle. Michael expect that, given the midterm election result, the U.S. economy should manage to grow, although the pace of growth should slow down toward the 2020 presidential election. Constance highlight that some of the risks, one in the U.S. labor market, concerns on whether the Fed would over-tighten, and also Constance highlight the other risks, in other places such as Italy and China. And Ebrahim also echoed Constance's concerns, some of the risks, in China, and also, highlight some of the tricky issues around the Chinese RMB. So I'd like to ask a few questions. One of the center on the U.S. So a lot of discussion on the U.S. business cycle basically is one of the top questions for all the conference that I recently attended. So one of the risks none of our speakers mentioned in your opening remark is the U.S. debt. We mentioned the fiscal situation in Italy, the debt problem in China. But in the U.S., the U.S. non-financial corporate debt topped $14.8 trillion in the second quarter this year. And debt as share of the GDP also rose to about all-time high. So do we worry about this? Will corporate America trigger the next recession?
I'm sorry.
Yeah, anyone can jump in. Yeah.
So I'm sorry, what was the end of your question? If the U.S.
Do you worry about the indebtedness of U.S. corporations, and will corporate America trigger the next recession?
So I think that there's a 50-50 chance the next recession comes and it's a global recession, or that there's a regional recession, possibly in the U.S. And given how tied the global economy is right now, it's possible that that also spills over globally. Yes, I'm concerned about a non-financial corporate debt in the U.S., mostly in the levered loan market, where there's been a huge boom. And again, this goes back to any of these off-balance sheet loans are indeed problematic, or have the potential to become problematic. So I would say I do have some concern about that. And it is not, we haven't escalated to the point where we were necessarily before the financial crisis, but it's definitely worth watching and bearing out. One of the things we haven't seen that I think we will start to see is the widening out of the BAA credit spread. So it's widened ever so slightly. I think when you see that move, then you need to be really concerned.
Okay.
I think the only thing I would add to that is the part of the question was, is it likely to be the trigger? I would doubt that accumulation of corporate sector liabilities and the things that Constance mentioned would be the trigger for a downturn. I think most of us think the risk is really monetary policy ultimately gets a little too tight, but certainly excessive leverage on corporate balance sheets. So you mentioned the leveraged loan market. I think that's a spot of concern. And the commercial real estate market is often cited as a second. So you could imagine that these two forces would exacerbate or prolong a downturn in the U.S. I doubt they would be the cause, but certainly they're areas of concern, and they would be ripe for kind of contraction should the overall economy turn.
Yep. Ebrahim, any?
No, I mean, I think that the two comments already captured greatly. I think the only thing I would add is last time around it was households that were at the epicenter, at least in the U.S., of where most of the pain was in the financial crisis. And it's natural to expect that this time around it'll be somewhere else. And I think a lot of arrows point to the corporate sector, and there are a couple of other candidates as well. But it's likely it'll be a different source from the previous time.
Okay, great. So it means that you have some concern, but right now it's still, not enough to, to the level would trigger the next recession. The next question also on debt, also on U.S., but this time is on the federal government. So based on the CBO estimate, U.S. federal debt to GDP will rise from the current 78% to 96% by 2028. So that's going to be the highest since World War II. So are you concerned about the U.S. fiscal situation, and what's the implication on financial markets?
My view is that it's not going to pose a problem. Some of this is due to the, let's call them special factors that the U.S. has in global capital markets. I think it's much easier for the U.S. to run large fiscal deficits and finance them with global capital flows that do not create a debt overhang. So certainly I don't think the path of debt is one that we want. But I think, is this the point where the federal deficit becomes a problem for the U.S.? I would doubt that. I think in a world where even when, like the post-World War II order is continuing to fray, there are very few global safe havens. The U.S. is still one of them. Right now it's the world's highest yielding safe haven asset. And I think there are very few places to go in major risk-off events. So I think the U.S. is still a prime beneficiary of the world as it stands today, and I don't see this as the number one concern on the horizon.
Okay.
Yeah, I would agree with that. I think the concern is more long-term about the possible crowding out effects. And I would say that we're tied for the second longest expansion in post-World War II history. You may recall at the end of the previous long expansion, we were able to run budget surpluses. So the fact that we are engaging in fiscal stimulus, so in addition to the tax law change it was stimulative, there was also the misnamed Balanced Budget Act of 2018, which spent an additional $150 billion in fiscal year 2018 and another $150 billion to be spent in fiscal year 2019. That fiscal stimulus is largely responsible for expanding the budget deficit, and short term I think that is a concern because that is not a sustainable trajectory. We cannot keep doing this over and over again. The assumption, I think, in it not being a concern is that that type of behavior doesn't continue.
Okay.
And I will just add, I mean, I'm definitely concerned about these fiscal trajectories globally. So there are two angles to this. One is, I mean, globally in the financial crisis, I think average DM, debt to GDP ratios in the public sector went up by 40 percentage points or so, and they're barely budging now. If anything, we're seeing a number of countries now considering late cycle fiscal easing. So both the scale of the increase in public debt was higher last time round following the financial crisis, and it's actually not falling at this stage, which is also unusual. And again, that's a pretty global phenomenon. But the US is unusual in the sense that the debt to GDP ratio stopped falling a long time ago, and it's already the highest across developed markets today in structural terms. And it continues to grow at this point, where growth, even in real time, is unusually high. So all those that were arguing that the U.S. stimulus will pay for itself are clearly not being proven right now. And whatever special status the U.S. has right now, and undoubtedly that will continue for some time, I do think it's being hollowed out because, as Constance just said, we seem to only be able to make any kind of fiscal agreements in the U.S. by deciding to spend more money. And there must be a finite limit to do that. And I think everybody, again, in the back of their minds, they say, well, when we need to do things, we will do so. And I will just remind people that's the argument we use in Europe all the time. And usually what we say is, yes, but things will have to get a lot worse before you get to that point. And I do see that risk in the U.S.
So I remember Winston Churchill said that, right? When the time's right, count on U.S. do the right thing.
That's right.
Yeah, this is still long-term concern. Okay. So now let's bring the question to a little bit more globally. So over the past few years, so we saw some of the setback on globalization, and starting from Brexit, then in the U.S., President Trump was elected as the president, and recently, we got Bush's version of Donald Trump. And then, what's your view on the globalization? Do you think this is just a temporary setback, or globalization here to stop?
So my view on this would be that globalization and multiculturalism, if I could put those two things together in a bucket, as fraught as that may be, that probably peaked in the early 2000s. Yep. So the normal metrics that we use to look at this, like trade as a share of global GDP, those have been flat to moving lower. Is this permanent? I don't know if it's permanent, but history would say that these things tend to move for decades at a time. So I don't think it's wrong to worry or have concerns about the next 20 years, what the rise of populism and nativism and just the policy stance across many economies would suggest about globalization and multiculturalism. I think there's a risk that we spent 40 years, 50 years integrating, and now there's a risk we're going to get a little too much de-integration. So yes, it's a concern for me. This is one of the forces we think underlies, pessimism around potential growth and changes in living standards, and you see this reflected in demographics in the U.S., where millennials are much more pessimistic about the long-run outlook than would be older Americans. So yes, I think that the ship has turned. You're seeing it also in a lot of bilateral trade relationships between the U.S. and China. You mentioned that China was the center of the global trade tensions. I'd argue that it was the U.S. We started it. So perhaps it's here. But yes, I think looking back, I remember the large protests of the World Bank and the IMF in the early 2000s following the EM crisis of the late 90s. To me, I kind of think that's when the pendulum turned, and there's been a lot more skepticism toward these multilateral arrangements going forward.
Okay.
Yeah, I mean, we are almost done time. I would echo that. I remember when Ian Bremer first told me he was writing a book and he was calling it G0, and that the G10 and the G20 was going away, and I said, oh, that doesn't make sense. And here we are. And so it made actually more sense than I would like it to make. I think one of the other things that's at the root of this, certainly we've seen in the developed economies, probably ex-Japan, is that we've seen an increased divide between the wealthy and the bottom 10%. And as that divide widens and becomes entrenched, you see political outcomes like the ones that you're seeing in Europe and the US, and even in Brazil, where we see increased populism. So periods of massive technological change and displacement give rise to a feeling of uncertainty, and if they're also coupled with a widening or dispersion in distribution of income, that can have really strong ramifications, not just nationally, but globally.
And I would just add that it's a nuanced picture globally, right? So we still see the EU strike trade agreements with Japan, with Canada, with a bunch of other economies. We see regional integration, particularly in Asia to some degree. So it's the US which is clearly pushing back in many ways. The rest of the world is a bit more mixed. True, I mean, also as Michael seemed to touch on, I think we are cleaning up in part some of the things that I think earlier on had taken place with perhaps not sufficiently much care. So globalization was much more faulty, I think, than many of us realized in real time, and I think it will take time to repair that. But at the same time, I also agree that I think we are looking at a period which probably will create more barriers than it will lower. And it is true that we have this climate which is pretty frictious when the global environment still looks pretty good. So I think it'll look even worse when we eventually enter that downturn sometime down the line.
Okay, seems that the comments are a little bit on the pessimistic side. So we are running out of time. I think I owe the audience one last question if I don't ask. So what's your view on the U.S. trade tension? What do you expect for the next few months? What do you expect? Yeah.
So for the next few months, do you want me to do the long-term part and then you do the G20 part?
Sure.
Okay. So just in the interest of time, I think the long-term direction of travel is certainly one of more confrontation. So if the last 40 years was about cooperation between the U.S. and China, I think the next 40 years will be much more about conflict, maybe not actual conflict, but where China wants to go is a much different place than where it is today, and I think that will put it in increased conflict with the U.S. in terms of intellectual property, technology transfer, national security issues. So the industrial policies that are being put into place today cause concern in the U.S. So there may be a temporary détente on trade, which I think Constance will address, but I don't think it in either of our views changes the long-term direction of the relationship between the U.S. and China. I think the shift is real. I think it started 2 presidents ago. I just think trade is the battleground under which national security issues are being fought at the moment.
Yeah, and I agree with that 100%. I think, and I think Ebrahim brought up a good point. You have, while the U.S. is escalating trade wars, you see, well, let me rephrase that. While the U.S. is certainly pressing this issue of trade and access, you see Europe negotiating with Japan. You see Europe increasing their trade footprint and lowering trade barriers. So so certainly globally, it's the U.S. that is pulling back. And short term, there absolutely could be an agreement at the G20. I think it will be more optics than reality. So echoing what Michael said, it'll be interesting to see how financial markets read that. I think that it's very likely we could see a lowering of volatility and a sort of happiness in the financial markets because they want to believe it's going to be enduring. But I don't know how long that will last and how long it will take for the veneer to come off.
And let me just end by saying there's a lot of excitement in financial markets right now about the possibility of some temporary peace between the U.S. and China. But I just wanted to say that I think China also, we have an unreliable negotiating partner in the U.S. There's no doubt about that. But China has to make some choices too. For many years, I think the message from China had been China deserves protection. It's a developing country. It's a poor country. But I think that has also changed very much in the sense that China, everybody knows China has real clout in the world economy. It's the second largest, probably soon largest economy in the world. Average living standards in some of the major cities in China are much higher than in some of the developed markets as well. So I think whether it's driven by the US or not, I think we will see pressure rising for China to take a much more active role, much more responsible role to some degree in global trade interactions. So we will see a continuation of the pattern that started by the US, I think to some degree mirrored by other trading partners as well.
All right, thanks for the insight and exchange. So fortunately, we don't need to wait a long time to find out the result. In less than 3 weeks, we're going to see what come out with the meeting if there's one. And, either we get a temporary ceasefire, either we will see a fast deterioration in Sino-US relation. I hope it's the former. And with that, let's give a big applaud for our panel discussions. Yeah. Thank you.